Good evening, everyone. Thank you for joining this evening's Corporate Connect featuring IHH Healthcare. This webinar is organized by SIAS and supported by SGX. We will kick off tonight's webinar with a presentation by Mr. Lionel Lin, Director of Research from SGX, on recent market highlights, followed by a corporate presentation by Mr. York Arley, Group CFO of IHH Healthcare, and lastly, a Q&A session moderated by SIAS. A little quick background for those of you who may not know, IHH Healthcare is one of the world's largest healthcare networks with 80 hospitals in 10 countries such as Malaysia, Singapore, Turkey, and India. IHH believes that making a difference starts with a simple idea: care for good. They have a team of over 65,000 people committed to deliver greater good to patients, people, public, and the planet. So without further ado, I'd like to invite Mr. Lionel Lin from SGX to kick off the session for tonight. Lionel, over to you. Thank you.
Hi, everyone. Thank you so much. Very good evening to everyone over here. My name is Lionel. I'm from the Singapore Exchange and I'm from the research team. So I'm really glad to have everyone here with us today. Obviously, we've got also IHH with us. So really today, I just wanted to spend a couple of minutes catching up with investors, right, with what's happening in the markets. So this is really about STI's defensiveness, right, amidst the recent volatility. So just a quick one on disclaimer. This is a purely educative presentation and providing an overview of the performance of our Singapore market in the first quarter, which just ended. So this is predominantly focused on the increased volatility that we have seen, especially with regards to the escalation of geopolitical tension over in Eastern Europe that happened in around late February. So just wanted to highlight to everyone this disclaimer here. Okay, this slide really just wanted to show everyone that for first quarter that just went past, right, we did a calculation across the regional global markets. STI, obviously a benchmark for the Singapore market, was APAC's strongest performing benchmark. I think if you look at first quarter numbers, right, just by price gain itself, there was a price gain of 9.1%. And if you add in dividends, it boosts it up to about 10%. So as you can see from the chart, right, it outperformed the ASEAN all share, which is at 5%. And most of the regional markets, and in fact, even on your extreme right, some of the developed markets in the West have seen a decline. So really, there has been a strength there. But obviously, I think if you look at it, right, the quarter can really be summed up into sort of like a two half, right? The first half would be probably from the start of January to late February. And then after that will be late February to end March. So what I mean by that, right, I think if you look at when the markets globally have the most volatility, I think that happened in late February when we saw Russia announce the entry into Ukraine, where causing a crisis over there in the country. So we've seen a significant pickup in volatility there. I think if you look at the chart at the bottom right, the STI 30-day historical volatility has in fact tripled the levels, right, seen versus the last week of December. So that has something that we have not seen for a while. So no doubt, if you look at it from a perspective, right, STI went down from late Feb to mid-March, but you can see that there's actually a recovery phase. So if you look at it from the initial leg down, right, spanning the 12 sessions from late February to early March, the strongest sectors, no surprises, were energy, obviously because of oil prices that ran, utilities and REITs, because I think some of the investors may have seen such sectors as safe haven to go into, while airlines, hospitality, and bank stocks, they saw the most decline. Interestingly, I think if you look at the recovery leg, which is early March to early April thus far, right? Airlines, hospitality, technology, and consumer cyclical stocks led the rebound, where you see energy stocks start to come off a little bit, So if you look at it from this perspective, right, we see airlines, hospitality, and bank stocks recovering majority of the losses. And in fact, if you look across globally, right, they are down by about 2 to 3% since the level in late February. Why is this so? Really, a couple of points here. The outperformance of energy and its adjacent sector of utilities makes sense because obviously oil prices remains high. Prior to this, Russia was producing about 10% of global oil prices. So the supply chain disruption especially has led to an increase in prices for commodities and energy prices. So I think second point, if you look at it, it's global reopening. I think if you look at a smoothened average of daily global COVID cases, right, it made a fresh low in recent last week, 1 or 2 weeks ago. So I think if you look at it from that perspective, many investors do see the reopening theme as something that's ongoing, or at least will continue over the next couple of weeks. In fact, I think if you read the news today, they were talking about how airports were struggling to manage the huge crowd and expected to continue over the Easter weekend. So really for REITs, reopening is clearly also a theme. But having said that, the global REITs hub performance have been relatively muted. In fact, you look at it from Singapore's perspective, right? S-REITs have outperformed in the current quarter, 1Q22, with a total return of about plus 1.3%. And if you average the declines across the major global REIT hubs, right, they are seeing a decline of about 5%. So really, this chart, this slide shows off a multitude of themes at play. And I think in addition to the geopolitical implications, what investors have at the top of their mind right now would be on rising inflation and also the rising rates, which is the rate hike cycle that's happening. And really, I think a lot of people are thinking stagflation, would that be coming? So these are some of the key drivers that we think will continue to govern the stock markets in 2Q. So what are the downside really, if you look at it from Singapore? If the interest rates spike up much higher than expected, we think this may potentially be a negative impact to equities market globally and also over here in Singapore. So looking at this slide 4, it talks about zooming in into STI, which are the biggest movers as the Ukraine crisis began. If you look at it from 23rd Feb to 8th March, right, the most defensive stocks were, like mentioned earlier, the defense stocks, also the utilities. In fact, if you look at the top 3, it would be Sembcorp Industries, ST Engineering with 5%, Wilmar with 3%. Likewise, during that whole period, right, there was a down of about 7.2%, whereas in that period, gold actually went up by about 7%. So these were very interesting moves that we've noted. And if you see the biggest decliners during that period, from late Feb to 8 March, the biggest decliners came from the banks, DBS, UOB, Dairy Farm, and also OCBC, and also some of the cyclical stocks that are mentioned over there. So looking ahead to 2Q22, it is important to note that stock markets are not static, they are dynamic. So if we see any potential market moving announcements that come out, right, this will definitely have an impact on the market. So obviously, comparative valuations will matter. Market impact can also change. So right now, I think we are seeing oil prices have come off a little bit. Now, if you look at the WTI price, is probably at about $95 or so. So we'll see how that pans out. But as other drivers matter, right, we think that investors are now very focused on the continued supply chain disruption, especially with the current COVID situation in China, and also global demand and demand for consumer products, because inflation has clearly been a very strong theme in 1Q. Many of the countries have seen high single-digit year-on-year increase. So this is something that we should look out for. I think earnings still maintain much importance. Do bear in mind that we are entering into the first Q earnings season. In fact, some of the larger US large cap stocks will start reporting from Wednesday onwards. Likewise, in Singapore, many of our companies will also be announcing some of their first quarter highlights or updates. And we think that that will be when investors will be able to glean more insights into what happened in 1Q by some of these companies. The third slide, really, this is using our proprietary data from Singapore Exchange, our weekly fund flow data, which can be found on www.sgx.com/research. The upshot of it, we think the positive is really in 1Q22, as many as 9 of our 12 main sectors have attracted net institutional flow. So if you see from this perspective, the sectors with the largest insti flows will come from the financial services, telcos, and industrials, followed by consumer cyclicals. Whereas on the other side, you have technology stocks, which have seen an outflow by institutional investors, followed by REITs. Technology stocks, this can be quite explained away if you look at globally, driven by the US and also in North Asia. Technology stocks have seen quite a lot of pressure over there. So we have seen that sort of mirrored over here in the Singapore market. Just one point on REIT sector, do note, even though there may be an outflow from institutional investors, we have seen retail investors buying into REITs in first Q22. And in fact, if you break the funds flow down into weekly data, right, we have seen the trailing 4 weeks net insti inflows turn positive since about 6 weeks ago. So in fact, if you look at it versus 6 weeks ago, we have seen 6 consecutive weeks of trailing insti net inflows, and that potentially can be seen as a positive for the sector. On the REITs inflows, sub-drivers for the sectors has include the sector yield is still at about 6.3%. So if you view it versus the risk-free rates, it's still about 400 basis points higher yield, which is based at this historical average. And if you look historically, S-REITs have generally have lower correlation with US rate cycles. And last point really on S-REITs borrowing levels looks comparatively controlled. If you look at their gearing ratio, is at 37% and is much lower than the 50%. So to sum up my quick update, on a final note, really, global markets are clearly quite volatile in recent weeks. In fact, you have seen it over the past couple of days. There are a multitude of market drivers that are currently impacting the stocks. So with supply chain disruption, with inflation, and with rising rate, so we do think that like 2020 and 2021, the uneven economies, right, will prove to have certain friction within the global equities markets. So some of these impacted sectors, right, will be hit by the current key themes that I have mentioned earlier. I think with that, I'll end this short update and I'll hand it over to York for his presentation. Thank you so much for listening in. Thanks.
Thank you, Lionel. Up next, I'd just like to do a quick introduction. So we'll invite Mr. York Arley, Group CFO of IHH Healthcare, who will be doing a corporate presentation on IHH Healthcare's business insights and updates. Mr. Arley, over to you. Thank you.
Great, thanks a lot, Ben, for the introduction. Lionel, great start for this. Very interesting to hear your comments around volatility and what has been happening here in the market. I think one thing is clear, volatility is all around us. We had believed that going out of COVID or coming into a post-COVID period, we see more stability and further growth. Now with this Ukrainian crisis, of course, there are outside influences that make things more difficult. I think your comment around flight to quality is well noted. And I think in times of volatility, investors do try and look for substantive quality and sustainable or a little bit less risk-averse investment. Now, I had healthcare, as we've seen in your last chart, was somewhat flattish, I guess, in recent weeks. Now, I take that as being on the back of a couple of quarters of very bullish, strong growth of healthcare stocks in the market, IHH being one of them. And look, thanks a lot to SGX and SIAS for organizing this and for having me here, for having IHH here, and being able to present to you a little bit about what the company is doing, who IHH is, and especially where we're headed in terms of what our strategies are, and how do we believe we can create sustainable growth and sustainable value expansion. Now, maybe just a quick introduction. On the first page, we have 80 hospitals in 10 countries. Our core markets are Malaysia with 16 hospitals, Singapore with 4 very well-known flagship hospitals. And I'm sure most of you who have been here in Singapore, who live in Singapore, know the Gleneagles, Mount Elizabeth Novena, and our Shenton general practitioner group. Well, we have 16 hospitals in Turkey, clear market leader in most of these, or in all of these countries, and in India with 34 hospitals. Also there, we play a dominant role with our main platform, Fortis Healthcare. We are operating in several other markets. Of course, we're in Greater China with 3 hospitals, with a lot of great clinics, especially in the Shanghai area. And we have in especially Eastern Europe, but also in the Netherlands, for example, 1 hospital, and Eastern Europe, several hospitals, clinics, patient outreach centers, being part of our network to bring international medical tourists to our hub in Turkey. Where have we started? 2019. 2019 is maybe a bit of an inflection point for the company. New management started to arrive, and the company set itself from a very strong acquisition-driven growth path to look a little bit more inside and think, hey, what is this company actually standing for? And the company set itself a trust compass. And it's best described in the vision of the company to be the world's most trusted healthcare services network, to be focused and centered around patients and giving excellent medical care to patients, to our customers, to their families, and to put really the purpose of most of our team colleagues and staff into the center of the company's vision to bring great healthcare services to patients, and with that speak for ourselves and make people come back, trust in us, trust in our services, and say, this is where I want to be treated, this is where I want to be when I need help, medical support. Now, as a CFO, I of course then look at the next step. How did that then convert into financial performance? We should actually put here an additional slide in where we give a lot more reflection on net promoter scores from patients, on patient feedback. And especially during this crisis with the pandemic, we see a lot of support from people. We see a lot of coming together in this trust culture with the doctors who work for us, who partner with us, with the nurses, with our frontline staff. And I think this is actually the key message, that we see a lot of engagement from our team colleagues during this pandemic. Now, in terms of financial results, 2021 has been a great year. We've expanded our return on equity from somewhere below 3% to 8.4% in 2021. Of course, somewhat also supported by favorability during this COVID period. There have been revenue streams that we've been able to capture that added to this. Some of this may go away somewhat. So we believe there is an underlying ROE of somewhere 6.5%. If we take away some of this favorability, cash flow from operations has grown to 3.5 billion ringgit, and our net debt to EBITDA as a result of strong cash performance is reduced from 2.4 to 1.37. Our net debt to equity is at, I don't know, somewhere 0.2. So I don't think we can say we are completely debt free, but if we look at the pockets of debt that we have on the balance sheet, it's primarily focused on our real estate business, our Parkway Life REIT fund that we have listed here in Singapore, and our operations in Fortis. There are some small debt left in Turkey. So with this refreshed strategy and with this new north around patient-centered trust, we have then looked at what's in there for us in this 10th anniversary year as a listed company. 2022, we are listed for 10 years. And the purpose of our business and of the people is touching lives and transforming care. It is circled around this patient centricity. So care is really one of the things that distinguishes us from many other businesses. And our key slogan for 2022 is care for good. And for good doesn't only mean, well, for a long, long time, and that's the purpose of the company, but care for good also in doing good to the communities we live in, to the patients we work with, and who come and trust us in helping them. Now, if we go a step further and then say, what are the trust pillars that we have under this care for good? It is this patient-centric trust. It is a synergy focus to say we have 80 hospitals. There must be a reason why every one of these hospitals is on our platform. So we need to bring some synergy value, parental advantage to the business. We need to pivot back to growth after a couple of years of focusing on optimizing the operations. We do want to have a new growth pivot, and I'll talk about that in a minute. And of course, sustainability. And I'm personally very proud that we've been able to discuss with our board, with the management here, to add this fourth pillar into our key strategic agenda, sustainability. It is absolutely paramount that we not only focus on financial results, but also focus on social and environmental and sustainability results and sustainability returns with our strategies and our activities. So let's talk quickly about each one of these pillars. Trust. We see trust really encapsulated in looking at the outcomes of what we do with the patients and with the people we work with and who come to us and entrust their lives to us. So the perception of value of our services is actually in looking at the outcome, the quality of care, the cost of care, but then also that there is a result, and that's typically an ill patient or a patient comes to us to be treated, and then how much does it take, and what's the quality of care, what's the service level, and what is the cost to bring this patient and give him a resolution to his medical treatment topic. So looking at value-driven outcomes where we look at the quality of care, the cost of care, and the outcome that this cost brings. That is our view on value. It is not about how much can I charge a patient and make the most dollar out of it. It is about how little can I charge a patient to get it to a defined outcome. And that is our contribution to the overall rising or not rising healthcare cost. Synergy is another key element. Owning 80 hospitals and working with every one of these operators, we need to look at what is the parental advantage we give to each one of those participating hospitals. And one topic is around extracting synergies with our Cerebral Plus program. Cerebral Plus is a healthcare information system that we have developed, or that our subsidiary Acibadem in Turkey has developed. So this is an in-house, own self-developed technology healthcare information system that provides us with the operating platform in each one of our hospitals. We've taken this system, we've expanded it, adapted it to the Malaysian regulatory and operational environment. We're rolling it out in Malaysia right now. We then proceed to Singapore, and we will make this available to hospitals on our platform. So the whole notion of how do we operate as hospitals and how do we support that with good systems and tools and processes is behind this Cerebral Plus. And it's also a signal that we work really well together with our colleagues in Turkey, who are here the source of intellectual property and of this know-how. Another area is procurement. We have in 2021 far exceeded our 100 million ringgit cost-saving targets that we've set ourselves for the group procurement program. And for 2022, we've set a very similar target of 100 million cost saving. And I think we want to get into this capability and flex the muscles around how do we create cost savings and added value to the participating hospitals and clinics. And look, ultimately, cost saving is also helping us to manage healthcare costs overall. It is, again, as I said before, not about charging and upcharging patients, but also to contribute to the overall containment of rising healthcare costs. Now, growth is, being a Malaysian company and a Southeast Asian enterprise, of course, a very important factor in determining valuation, market value, and investors who invest in us don't invest in us because we're a great dividend stock. People invest in us because we're a growth enterprise. And we have defined for our next several years 5 growth pillars. And I'll get through them. Recover from COVID is, of course, one element. What does that mean? It means re-attracting and reintroducing substantial growth from medical tourism. We had, for example, in Singapore, 20-25% of our revenue was from international medical tourists. We are now far below 10%. So we are coming out of COVID and with travel restrictions easing up, coming back with growth opportunities in this medical healthcare, healthcare tourism space. Organic growth is a second growth pillar, and here we talk about, well, primarily asset utilization. Bed occupancy rates have been still in Q4 2021 at around 55% across the group. Now, if you say you want to go from 55 to 65% bed occupancy rate, it means a nearly 20% growth opportunity without adding additional capacity and without adding substantial capex to it. So the achievement of strong organic growth and getting back to bed occupancy rates of 65 or maybe even 70%, this is a key driver for our return on equity journey and expanding asset utilization across the group. Organic growth also means our cluster growth strategy, where we try and focus on key markets, main cities, large cities where we already have infrastructure, and adding to that infrastructure and gaining market share in an area where we know how to operate is substantially less risky and helps us to have much faster payback periods for our business. Now, after this pandemic and after looking at the basis for our business and getting into synergies and trying to optimize cost structures, and on the back of a very strong balance sheet, the acquisition of strategic assets is obviously a new growth trajectory that is possible. We feel we have a very strong balance sheet. There are a lot of assets out there that we believe would fit very well into our portfolio. This can be hospitals, this can be laboratories, this can be other assets. So looking into strategic growth drivers is extremely important for us to continue a long-term journey as a growth stock. And I think if we look, and I mean, some comments you saw with regards to potential acquisitions in Malaysia and Indonesia, as one example where you have exactly a focus around cluster growth, where in Malaysia we are already very strong, and add and contribute to that network there, and enter in Indonesia not with a greenfield flag planting large new hospital, but entering by acquiring a complete cluster. Now the deal is we're in very early stages in this deal, so it's absolutely not clear yet whether this materializes or not, but it is an opportunity that we're pursuing, and we will look into assets that fit strategically to our portfolio. Now, the laboratory business during the COVID period has turned out to be really one of the gold nuggets in our portfolio. And if we look at the strength of this and the growth trajectory of this laboratory business, it's really something that we want to put into its own right. So we do look into verticalizing our laboratories in Singapore, in Turkey, in Malaysia, and at a later stage, also expanding the collaboration with SIL in India and bring this laboratory diagnostics focused business into its own right. A super high growth ROCE trajectory in that business, and that makes it super attractive also for investors, of course, to look a little bit into capital allocation, into high ROCE stocks. And then last but not least, innovation and digital transformation as a new revenue stream, as a new technological advancement that is very patient-focused and patient-centric, with an ability to create a digital ecosystem, get closer to patients, get closer to customers, offer our services in a much more seamless way. I don't want to go into all topics, but diagnostics is something that we find is really interesting. COVID-19 has, of course, changed the environment in our laboratory space. People are much more attuned to go out, buy tests, laboratory tests, get health information about themselves. It's again about patient first, it's about wellness. People do want to look at themselves in a more holistic manner and maybe address issues before becoming ill. Big data is a big theme here because we make millions of lab tests that can then lead to great insights into health trends in certain countries or with certain groups of the population, and digitalization is a key enabler in that industry. We have 63 labs in Malaysia, Singapore, and Turkey, and another 428 labs in India through our investment in Fortis. If we add together all the staff, you have nearly 2,500 people working on this. We made 75 million lab tests. So this is a very, very strong business. We are market leader in basically every single market that we are in, and we will build on this and invest more money to drive further growth. Innovation into technology, and I just want to go into this picture that starts, of course, with our key hospitals. That's the most intense care that we can give to patients once you're admitted to our hospital. But there are several other layers of service and support that we want and we can provide to patients and customers, as a specialist, a general practitioner, remote care, self-care, and prevention. And we believe by shifting that care journey downstream and offering more and more and more support to customers and patients who are in our ecosystem, this creates additional revenue streams for IHH. Now, sustainability, as I said, is something that has been with us for a very long time. But we are in the process of looking into this, into an even more comprehensive Trust 360 focus as a concept that circles around 4 P's: patients. We want to empower our patients. We want to look at public doing the right and the good things for the communities we work in and we live in. We do want to focus on the planet, protecting the environment, doing the right things, and providing care, but in a responsible and environmentally friendly manner. And we want to, of course, focus on our people, providing a great workplace for the people, a safe and healthy workplace that is based on inclusiveness and diversity and giving opportunities for all our teams to work for us. Now, before we turn back to Ben for some Q&A, just quick financial highlights. As I said, 2021 was a really good year. Strong growth, 28% compared to 28% top line growth compared to 2020, 49% EBITDA growth compared to 2020, well above 2019 pre-COVID levels. If you look at net operating income, that is our net income without extraordinary items, we have a 123% growth versus 2020, and you can see the trajectory improve here. 2020 was very COVID affected in Q1 and Q2 especially. And if you then look at the net income, as reported, substantial improvement, not many extraordinary items. We've overcome the period of large write-offs and are now in a financial performance level where we feel with this we've reached a new financial trajectory that we're happy with and want to continue on. Let me pause here, maybe pass back to Ben for some Q&A.
Okay, thank you very much, Mr. Ali. Very grateful that you're able to join us this evening. It's always, good that the CFO or the senior management sits with us, retail investors, and explains some of the trends that's been happening to the business. So, thank you very much for joining us this evening. We do have a couple of questions coming in from the Q&A panel, but we're going to kick off first with 3 pre-submitted questions that we got over the last week before today's session. I'm just going to paraphrase some of them and ask you on the air, to get your take on it. So the first question would be, what are the new opportunities for growth for IHH beyond its current portfolio of businesses?
So if you go back to the areas that I spoke about in terms of the growth trajectory of the business, and you talk about what is really new, I think the first element that is new is a focus around a vertical. In the past, we talked about hospitals and inpatient, and it was primarily around activities that ultimately lead to an inpatient situation. Now, with this new thinking and presentation and discussing around the laboratories business, where already today, 35% of the core business of the laboratories is not IHH business, it's third-party business, where we sell services to third parties, to doctor groups, to other hospitals. I think that is a real new revenue push, where we see a growth trajectory coming outside our own operations and captive markets. So I think the area around laboratories-driven growth with third-party clients and customers is very important. Now, what adds into this is an expansion of the testing library, a constant expansion around capabilities of the labs, a constant expansion of collection centers, laboratories. And look, we have in some markets now in India, we've started drone collection of test samples. So you even expand beyond very traditional ways and get into very agile ways of working. Now, I think a second growth area that we've learned during COVID are new revenue streams. So we've worked, especially here in Singapore, with the government on arrival testing, on very agile ways of setting up vaccination centers, on I don't know, one day the government says, okay, we need to have a new testing center in a bus terminal, because that's where we have a lot of tourists or buses from Malaysia arriving. And then, of course, you need to be very quick and agile and be able to set this up. So this whole notion around new revenue streams in the healthcare space, how can we work and collaborate with others to build new revenue and new business? I think that's a very important element. And the third aspect, maybe that's a more longer term aspect, is a revenue streams around subscriber models, where you say, can we be an ecosystem and a platform where a user subscribe to our services on a healthcare app, and he's on this app, he trusts us with his data, and in return, we provide analytics to him or her. We provide support in remote analytics, in storing his data, in booking doctor appointments, maybe calling a doctor, maybe getting automatic workflows with prescriptions and tie-ins with specialist doctors who then can expand services to patients and to people who are ill or maybe not even ill yet, and we can help people prevent illnesses. So these are new revenue streams and new revenue thoughts. Maybe they're a little bit more longer term out, but we do really think this is important to expand our overall offering.
Thank you very much for that. So what really stuck in my mind, just now was that you guys are doing drone collection of samples in India. I mean, Amazon can't even get this right, yeah? I mean, the drones crash and burn for you guys for doing this. So kudos to you guys. That's, impressive. Very good. Okay, I'm just, I think we are probably going to have more questions than we've got time for. I'm just quickly passing through some of these questions here. Okay, so in the same vein, with regards to expansion of businesses, what is IHH's strategies on on Greater China with the series of impairment on Gleneagles Chengdu. Does it suggest a much tougher operating environment?
Yeah, look, that is a very good question, and I think we also have to be honest and realistic here. I think there was a strategy to go into China, and that was a good strategy. It was a belief in an opening up of a private healthcare space. And I think going in and having partners and local partners, I think the belief was this is something where we, with our Singapore, Malaysia-based business model, can be very successful, because we build on operational excellence, we build on medical and clinical expertise. So there was a belief, if we go into China with this, this is great. So we bought a clinics chain in Shanghai. It was very expat focused, but there was a belief this is a good basis to operate. Now, I think the reality is, over the last years, first of all, the Chinese market, and especially Chinese consumers and patients, are different from where we are here in Singapore or in Malaysia. We also have really strong local healthcare platforms. Government hospitals are very well known, and doctors who want to make a professional medical career do circle and do need to stay in government hospitals. So over time, you do realize that there are challenges in retaining staff and hiring and getting talent for the operations. Working with local insurances is not as easy, is more challenging. Acquiring and getting patients into Chengdu, for example, turned out to be a lot more complicated and difficult. Ramp-up period was longer. And I think with COVID, the market also has changed. Regulation is changing. It's becoming much tougher for foreign investors to be successful in China. So I think there are some of these realizations, and look, you just have to look into the newspaper about comments that politicians make in China around private healthcare to know this environment has changed. And I think we are eyes wide open. We are realistic about it. And I think the important thing is that we realize we need to change our approach. We need to change our ways of working. And that's what we're doing. Yes, give us a bit of time until we get through this, but we do need to find new operating models to be successful.
Okay. I mean, certainly China has always been a, I guess, challenging environment for companies outside of China. So that's, I guess, par for the course. I've got two questions here. We deal with a little bit more specifics with regards to your finances as well as your operating model. So the first one is, for hospitals under management, are they owned, or rather wholly owned by IHH, or are they leased? And if they are leased, would you be able to comment on the expiry of their leases?
So it's a bit of a mix. Here in Singapore, 3 or 4 hospitals are owned by Parkway Life REIT. Yes, we control Parkway Life REIT, but we only own 36% of it. So it's a bit of a mix. So some assets we own, some assets we do not own. In Singapore, we've just renewed the rental agreements for another 20 years. So this is very long term. In many hospitals in Turkey, where we have, or in some hospitals where we have rental agreements, they are mostly long term rentals. But I think the key milestone was really here in Singapore to renew the rental agreement with Parkway Life REIT to a new 20-year engagement. Now, the good news is that Parkway Life REIT also said they want to invest 150 million Singapore dollars into the real estate to upgrade it, to make it even more modern, and to basically join us in bringing these hospitals into the next growth phase.
Okay. All right. That actually answers the other question that we have. Okay, moving on to the financials. There was a question here about the savings of 100 million Malaysian ringgit on procurement. Would you be able to comment on how IHH intends to achieve that savings?
So we have started last year a project that we started with a consulting firm on a success contingency, and it divides itself into several areas, right? One is capital expenditures. How do we negotiate with equipment manufacturers better and more effectively? How can we pool purchasing decisions, have better, more efficient tender processes? Second part is pharmaceuticals. And I have to tell you, we're not really inspired by some of the response from pharmaceutical companies. I think there's a huge resistance to offer market competitive pricing. That is certainly an area we have to do a lot more. We've had more success in consumables, where we are able to align specifications, try to syndicate specs and pool sourcing. We have, for example, been able on rubber gloves to have global transactions, global deals negotiated, where we supply from Malaysia our Turkish operations. So I think it's really a lot of work in going into your master data, into your real day-to-day transactions, align and pool equipment purchases, material, pharmaceuticals, and in some areas it's about white label products, right? It's not everything needs to be branded. Can we replace branded products with white label products of the same or maybe even better specifications and quality, but at a much lower cost? So I think it's a broad array of tools. Hard negotiation is 20% of the success. 80% is really understanding your data, understanding what you're buying, and being able to collaborate with suppliers to achieve cost savings.
Thanks for that. Your comment just now about hard negotiations with the pharmaceuticals, that resonates. I mean, pharmaceuticals generally is quite a tough nut to crack in terms of negotiating for cheaper prices. Alongside with that, would that also suggest that IHH looks into sourcing generics in terms of drugs rather than the Pfizer's and so on and so forth?
Look, I think it's one strategy. In the end, the decision on what medication goes to a patient is done by the doctor. So our task is not only a procurement task, it's actually much more of a selling task. How can we make it appealing to a doctor to say, look, we have something for you, and if you prescribe this and use this, it's as good or maybe even better for the patient. I think that needs to be at the focus of what we do. So it's not about squeezing the last cent out of procurement at the expense of quality of care. It is bring the same quality of care, but at a lower operating cost, and to collaborate with doctors in this process. So generics obviously is one area where I think many people say, hey, why not? Why not go to a generic supplier who just offer sometimes even better medication at lower cost?
And I suppose that harks back to what you were speaking about during your presentation about being client-focused, patient-centric, not just about gunning for the bottom line. So that's quite heartening to hear. Let me see. Okay, there is a question about was it legal complexities in India, resolution of the Supreme Court of India? Is there an overhang there?
Look, there is of course an overhang. The Supreme Court topic in India from our investment in the Fortis is clearly an overhang. We do believe that this will be resolved in due course. We are saying since 6-7 months that next month we will resolve this, and we say that each month. So actually we really need to wait for the Supreme Court to come out with a conclusion. We feel we have done justice in supporting the government and supporting the judges in coming to a conclusion. I think now we have to be patient and wait for a resolution. I think we had good arguments on our side. We are expecting an outcome with which we can live.
Okay. And again, comparing to Amazon, Amazon had a really hard time and they had years-long litigation, right? So I think that's part of the cost for the legal processes in years. You have to wait. That's how.
Absolutely, you're absolutely right. I mean, it's just part of doing business. And look, if you go to the United States, I don't think it's going to be much easier there in that topic. So it's totally fine. It's part of doing business.
Okay. Let me see. Okay, there was a question about the debt load for IHH. So you spoke about the debt in your presentation. Very specifically, there's a question here about the debt load increasing from, or rather up to 32%. So the question here is it too high for a company of this size?
Yeah, I think we have a lot of discussion around what is the right debt to equity or debt to EBITDA level. We've done benchmarks. If you look at some companies, they have a net debt to equity of well above 1. I doubt we would ever want to be there. But at 0.2, 0.3, is that really a leverage level that the market supports? The impression we're getting is that there is room to leverage up somewhat more. And yes, of course, the first step is the redemption of our perpetual bond that is outstanding. We will refinance that partly with cash on hand and partly with new debt. We're very unlikely going to issue a new perpetual bond. It's at this stage far too expensive, and there's not really the need for that. So look, what is the right level? Is it 0.5, 0.6, 0.8 net debt to equity? Is it 2.5 net debt to EBITDA, 3? We will be responsible, will not over leverage, but at the moment, I think there's still room to increase debt somewhat.
And I suppose part of the equation ties back to your expansion plans, right?
Yes.
And, obviously, in order to scale operations, you need capital, and part of that will come from debt. So.
Yeah, absolutely. But look at the last acquisition we did, PCMC in Prince Court Medical in Malaysia, and we've basically paid back that loan within 12 months. So even larger acquisitions, we're very cash generative business. And I think we should deploy these funds and invest into growth.
Okay, great. Let me see. How does IHH participate in SG, or rather the Singapore government's long-term plan on managing overall health, rather by symptoms? I'm not sure what that means. But I guess the whole question is, how connected is, or how synchronized is IHH with the overall government's policy on healthcare management?
The teams are super connected, and you can see that in how well we collaborate with the government in terms of providing beds for COVID and getting new services out, in discussing around regulations. So I think that there is a very, very strong collaboration. A lot of the colleagues we have here have very strong ties back to government services. And look, we don't see this as a competition between private and public healthcare. We see this as a joint effort to help the country to expand healthcare and care for patients and care for people. And look, the latest policy around general practitioners and that the government supports and suggests everyone should have a good GP who basically cares along the life cycle is a very good and very supported policy from our perspective. We believe a GP can be very instrumental, and with our investment in Shenzhen, we provide some part of that, and this could also be a growth area for further expansion.
Thank you very much for that. There is a question about the dividend. So in your presentation deck, the dividend, rather the dividend in dollars and cents was 6 ringgit, right? 6 cents ringgit. But I think the PL ratio dropped a little bit. So the question here is that the dividend, I guess, PL ratio seems to be a bit low. Would you be able to elaborate on any forward guidance with regards to the PL ratio?
Yeah, look, I think we had a very healthy debate with the board and around this topic. And of course, you have two things, right? You start with 4 cents and you go to 6. That's a 50% increase. That's chunky, right? That's a huge increase.
Yeah.
And once you increase, you don't really wish to reduce again. So you really need to be sure, okay, the step to 6 is a good step. And everyone on the board was clear that there's room for more. But then the question was, is a 50% increase not sufficient at this stage? And then say, okay, look, a year later, or should we do a special dividend? So there still was a strong sense of responsibility for the company, for the business, and say, look, there are many other companies out there suffering, and you should do the responsible thing. So we said 50% increase is sufficient at this stage. There clearly is room for us to grow. Also, we want to be perceived as a growth stock. So it's not like this means now that we keep all this and fortify our balance sheet too much. Now, 28% payout ratio, agreed. That's a bit of a reduction. Now, last 2020 was not as good a year as this year. So, of course, there's a bit of a reduction. Our policy is to pay out more than 25%. So I think we are in line with our policy. I take it this way, a 50% increase is a strong expansion of dividend payout. It's a sign we want to be above 1% dividend yield. And look, let's see and wait for more.
Okay. And I suppose in this kind of challenging environment, it makes sense to kind of, I guess, keep your gunpowder dry. Given what's been happening, and also the need to kind of control the debt levels. Right. Okay, a question about Indonesia. How do you view the operating environment there relative to your current markets, and do you expect universal healthcare coverage there to be a challenge?
Yeah, look, Indonesia is a new market for us. So I think we need to, before we finally make decisions, really understand this better. I think there is a good asset out there that is available, and we are also in discussions with potential local partners. Let's further see how regulation develops. We don't see this as a huge topic for us at the moment. Indonesia for us is, of course, a major source market for medical tourists. So in that sense, investing in Indonesia is like an expansion of our value chain of our Singaporean business. In that sense, I think we need to look at it from a more strategic perspective. We see there's substantial growth for private healthcare in Indonesia, so we see it as an attractive market, but the asset needs to be the right asset to invest in, so we don't see at this stage too substantial risks, but a lot of this needs to come out in due diligence and in further studies.
Okay. Well, apart from Indonesia, as well as the countries which you currently have got businesses in, one of the questions is, what is IHH expansion plans beyond the countries that you already operate in?
So look, I think Kelvin had coined this term cluster growth strategy, and it suggests that staying close to markets that we understand is preferred to getting into markets we don't understand. So I think there's a large desire to really expand market share in those key markets where we're in. We will see growth in India. If we can expand in Malaysia, that would be great. Turkey is an amazing growth market. with the network Turkey has into Eastern Europe or an expansion in Amsterdam. These are things that are very close to us. I think we can understand this well. Stepping into something entirely new would really need to be the right asset. It would really need to have a clear view how we manage this and what added value we contribute to the business. I think the desire to create a great flag planting exercises to say, oh, wow, we've entered this market. I think we need to understand how to operate. That's the key objective here. And there are a lot of opportunities in markets where we already are or where we know how to operate. And look, there are some forays the company did in markets that we don't really fully understand. I think we want to avoid such mistakes. I don't think it inhibits our growth. I think it helps us get synergy value and create value from the investment.
Yeah, I love the term they used just now, flag planting. So yes, so IHH is not in the business of flag planting. I think that's a welcome relief to all shareholders out there. Yeah, I think that's great actually. Okay, related to that, there is a question about the target customer base. So one viewer here is asking, is there a certain target customer base in terms of, for example, mid-tier or high-tier, so on and so forth, in which IHH targets?
So I think it's a question of which market you're looking at. So if you look at Malaysia, for example, we have different hospital brands. We have different tiering. We have a Pantai a platform. We have the Gleneagles platform. We have PCMC, which is like a 6-star hospital. So I think it's really depends on which hospital you're looking at, but it also reaffirms this whole cluster approach. Because in each cluster, if it's large enough, you have different tiers of target customers. And I think expanding in the markets you know well likely creates more value than saying I'm only a premium customer and I only do 5-star. I think that's likely not the right strategy. Even here in Singapore, we look at different tiers, we look at different activities. I think it's not so much a question of that one particular customer group we're looking at. We want to provide general healthcare, but of course, we're not a low-cost supplier. We're a premium healthcare provider, private healthcare provider, but we do look at not just one income group that we target at. We do look at a whole pyramid.
All right, well, we've run out of time, but we do have one more question and then we can wrap it up for the evening. The question would be, in your opinion, would you say that the current share price for IHH is reflective of the company's earnings as well as growth potential?
Well, look, that's the market to decide for us. I think you can imagine our view. I think we have a strong growth trajectory. We have expanded our return on equity. Has the market fully encapsulated that? Well, maybe we need 1-2 quarters more to show you that we stand behind our projections. Ultimately, it's the market that decides the price. I personally believe there is room for expansion and valuation. I think we have a strong underlying cash flow. I do feel not all of this has been recognized yet, and I hope that sessions like today help the audience to gain confidence that we know what we're doing. We're trying to avoid accidents and want to continue a growth journey.
Yeah, so I kept the best question for last, as you can see. In all fairness, a quick survey of the analyst reports out there, for our viewers out there, they do put IHH as a strong buy actually, with a target price far above the current stock price. So take that as you will. So for our viewers out there, please do read the research reports, right? I think that is probably a good indication of where the stock price for IHH should end up. All right. And that is all the questions that we have for this evening. I want to personally thank Mr. Ali for sitting down and answering all our questions without the script, and very candidly, it's been a pleasure speaking to you, Mr. Ali.
Thank you. Thanks, Ben.
Over to you, Zach.
Thank you, Mr. Ali. Thank you, Lionel, and thank you, Ben, for this insightful sharing tonight. We have come to the end of the session. Thank you, everyone, for joining us this evening. In case you missed any of part of this tonight's session, you can rewatch it on SIAS YouTube channel. Corporate Connect is a bi-monthly webinar, so do visit our website to get more updates on upcoming investor education programs and initiatives. The upcoming Corporate Connect will be featuring Elite Commercial REIT on the 29th of April. So stay tuned and do register if you're interested. Thank you and have a great evening, everyone.